Fredrik Nerbrand, Global Head of Asset Allocation at HSBC Bank. Why is that?
Well, it's a sense of in terms of why we're staying with the risk rally first off, is that we're still seeing improvement in terms of economic momentum. We're seeing valuations aren't really a hurdle. We're also seeing a number of different elements in terms of that are improving, but those are short-lived aspects. In terms of the actual foundation, in terms of the economic foundation, in terms of this rally, are more based on shaky foundations as far as we're concerned. So we're highly concentrated on what's happening to the near cycle, business cycle more than anything else at this point, rather than trying to focus in on policy changes, etc.
So then can I just ask you if you think do you think the recent positive data out of the US then, is that just a temporary improvement as opposed to something more structural, something more fundamental?
Well, yes and no. I don't think it's quite as simple as that.
Okay.
At the end of the day, we live in a very integrated world. So the fact that we see one thing improving, that often leads to other things also improving. There you get this positive feedback loop. And it's that positive feedback loop, and to some extent, that is driving this. But it is a question of whether or not that's a positive feedback loop around a structural improvement or a structural disintegration, and it's more likely that we'll see the latter of the two, I guess.
Yeah, and so to that end, I know that this chart is something that you keep a very close eye on. It's been compiled by HSBC, and essentially this is, just to give our viewers a little bit of background, it's compiled from about 120 global leading economic indicators to gauge the overall momentum. And so just, where is the world heading right now? Because I mean, if we look at the way that line shot up after 2008, after the financial crisis, we're not obviously back up at that level, but, is there a risk of the recovery getting off to a false start now?
Yeah, the way that I view this is that we're seeing this rebounding, and that's good news. But it's also important in terms of these turning points. The peak in that was in July 2009. That was a long, long time ago. Yeah. Actually, that type of indicator that we compile went into contracting territory in January of last year. So I think that the difference between how people view the markets today is that we are still focused on these structural issues, but the difference between this time last year and today is that actually economic momentum is actually improving. So in terms of markets being stronger, beginning of this year is on much better footing than it was at the beginning of last, where we were much more skeptical about the risk rally from a tactical point of view than we are at the moment.
Does that mean that you don't think the rally will last into the second half of the year?
Well, I think the way that we look at this, right, so you need to be data dependent, but you can't be data dependent on ISMs and normal PMIs. You need to be data dependent on the most forward-leading indicators you can put your hands on. And that's what this type of metric is trying to do, right? So it's looking at global indicators because the world is a global place. We can't just look at single country data. And so what we're saying, as long as that keeps improving, we're more favorable towards the risk rally than anything else.
It's a global place, as you say, and increasingly more integrated. But nevertheless, we're seeing some remarkably different situations, if you like, between, say, the emerging world and the developed market. I mean, you just have to look within the Eurozone itself and you see how divergent economies are. So, how does that factor into your thinking?
No, that's a very good question. So we've done a lot of analysis on that, and I think the way that markets, at least in terms of our back tests show, in terms of what actually tends to matter, is actually not necessarily the strength. So a lot of people focusing on like what a PMI is, if it's 45 or 50 or 60, whatever. But actually the way that markets tend to work is actually more the trajectory of those. So it's a change of those that actually matters. And that's what this type of momentum indicator is trying to capture. And actually, if we look at economic momentum in the Eurozone versus the rest of the world, one would have said that actually that should have deteriorated before the rest of the world. I think that's a common held belief. Actually, on our metric, it actually deteriorated similarly back in January of last year, and it's picking up now just like it is everywhere else. So the levels are different, but the momentum is relatively
And Fredrik, deleveraging is a big theme in the markets, isn't it? And you say that there is evidence of an underlying shift taking place, showing that bank lending is no longer shrinking in real terms. What exactly do you mean by that?
So the way that we kind of assess this, it's like a lot of the world thinks about the world in year-on-year numbers and month-on-month numbers and so forth. So instead of like looking at that type of metric, what we do is that we look at real bank lending for each individual country. We regress a line through that, and we look at the slope line of that for the last 24 months. And actually, if you GDP weight these up, this sounds very complicated, but if you GDP weight that up, then actually you get to a number which is no longer negative. And if you're looking at the last observations around that, so you're looking whether or not this is accelerating or decelerating, in the developed world, we're actually seeing an acceleration of bank lending rather than anything else, which is contrary to, I guess, what most people are assessing. Now, that looks very different.
Is it filtering through into the real economy?
Yes, to some extent it is, because if you're looking at this in terms of, this is commercial bank lending, and that's what tends to be what we're focusing on. Of course, there's deleveraging happening on other parts of the economy from fiscal and consumer elements. But on the commercial bank lending, which ultimately we believe are more likely to lead if you're a subscriber to supply-side economics, than consumer data, then at the end of the day, that's actually relatively good news. So as long as that keeps accelerating, which looks different in Europe, it's decelerating in Europe, and it's very much of a different picture. But at least from a global perspective, it's not.
So how do you reconcile this view, the skepticism that the risk rally can continue with the fact that you're cutting your exposure to US Treasuries?
Well, because we're looking at the world from a strategic point of view, we're buyers of these, right? But you can't just buy and hold assets as far as we're concerned.
Yes.
The economic cycle is much shorter and it's much more volatile. And because of that, you need to be tactical in the way that we deal with things. So our tactical positioning is very much in favor of equities, which we favor over credit, which we favor, again, over treasuries. So it is a question of whether or not, which time frame you're looking at this. So from a 6-month basis, forward basis, we're actually relatively optimistic. Then if you take a strategic view, we're anything but optimistic.
Well, exactly. So, I mean, and that's what I'm wondering. You're not very optimistic, and if you just look at some of the immediate risks that we're facing, recession in the Eurozone, higher petrol prices, a hard landing, or difficulties, let's put it that way, in China, then surely you would want to advise holding haven assets within the portfolio.
Of course. I mean, it's about how you weight these things, and how you weight things now compared to how you would weight things on a strategic basis. So on this type of basis, we're now buyers, and we've been buyers since January 5th. But as any time in the future where we would see economic momentum starting to trail over from a global perspective, because actually that matters much more for equity markets than what's happening in Europe, for example, from a singular point of view.
All right.
And then we'd go back to our normal bears.
Fredrik, we've seen growth assets falling today off the back of those Fed minutes that Sarah was talking about. You are increasing your weighting in equities at the expense of corporate credit. So why is the outlook for equities more favorable?
I think to some extent one is that short-term economic momentum is picking up still, but also it's a valuation-driven reason, is that if we compare company for company, we compare CDS over 12-month forward, either dividend yield or an earnings yield, on that type of ratio, and you do it in bottom-up assessment. Today, we're seeing much more of a value in equity markets than what we're seeing in credit markets from a true metric, which is much better than looking at indices, levels, etc. And that tends to correspond with times where you see equities outperforming credit. So,
let's just take a slightly broader perspective. I mean, volatility index, something that we watch quite a lot here, the VIX and the V stocks. I mean, as an asset allocator, do you sit back and you go, you know what, we've had a great run, but I wouldn't mind buying some protection for the overall portfolio? Is that what asset allocators look at right now?
It is, actually. I had a very similar conversation with clients this morning.
A nervous client.
No, well, I think there's a lot of people are looking to kind of protect their good performance, etc., especially if you're absolute return driven the way kind of I am, also in the way since I do my research. But it's, I think that it's interesting in terms of the VIX futures, that actually the VIX futures curve is very steep, and that actually tends to invert in times of market correction. So if anything, we're probably more favorable in terms of looking at a VIX futures curve flattener.
You just said correction there. Give us a level. What do you think we could draw back? A moderate drawback or a more severe drop?
I think it's a moderate one. Actually, the most common comment that I get from everyone, especially the ones who have missed the rally, which is a large group of people, is that people are looking to buy a correction.
Okay.
So,
all right.
That means you get air pockets, but not much more than that.
Well, really good to get your analysis. Thanks so much, Fredrik Nerbrand, Global Head of Asset Allocation, HSBC. Thanks for your time. That's